world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here. Hello and welcome to Rebank. I'm your host, Will Beeson. Lex Sokolin is the Global Fintech Co-Head at ConsenSys, the leading crypto software development studio and venture builder. As regular listeners know, Lex is one of the world's leading authorities on the intersection of crypto, disruptive technologies, and financial services. In this conversation, we get Lex's perspective on where crypto is focused today, the emergence of decentralized finance, and the practical implications for the financial services industry. In addition to the insights we deliver through our podcast and newsletter, Rebank offers advisory services to fintechs, banks, and corporates. Drawing on our experience starting, running, and advising fintech businesses, and our vast network of the most impactful fintech entrepreneurs, investors, and innovators around the world, we help companies make sense of fintech, work through specific questions, and optimize proposition and strategy. For more information about our services, please visit bankingthefuture.com. Thank you very much for joining us today. Please welcome Lex Sokolin. Lex Sokolin, welcome to Rebank.
Thanks for having me.
Actually, since we last connected, I think you've changed roles. And whereas previously you were focused on kind of all things fintech, including what I like to simplify as adult crypto, you're now pretty much exclusively focused on decentralized finance.
Absolutely. Adult crypto is great. I'm going to steal that and use it. I've left the world of research, and I spent 3 years building out a set of frameworks and mental models for investors who are generally conservative in their thinking about finance, and applying that to the innovation that we see across insurance, asset management, wealth, banking, lending, and so on. So answering a lot of questions like, what will tech do to finance? And in that journey, I got caught on a couple of themes, AI being one of them, blockchain being another, and mixed reality being the last. And AI and mixed reality seem like games for large tech monopolies rather than entrepreneurs, at least to me today. Whereas the blockchain-based world does have this fundamental grain of truth in it, this sort of fundamental transformation that it can bring to financial services. And the way to simplify it down is think about how we manufacture financial products today. Even if you sell them through Robinhood or N26 or Revolut or SoFi, end of the day, you're manufacturing the same bank accounts and the same investment accounts at a broker, powered by the same paper processes that you always have. Whereas decentralized finance and open source programmable blockchains give us a really spectacular tool to start from the ground up with an infrastructure for financial instruments that can make them essentially free to make. And I think that's a really interesting place to be.
Okay, so what's your official title?
I'm the Global Fintech Co-Head at ConsenSys. So I look at everything that's fintech software in our strategy. More specifically, I co-lead a business division called ConsenSys Codify. And Codify is this operating system for financial services that would sit on top of global open source programmable blockchains.
Okay, so ConsenSys is simplistically kind of like an incubator / venture builder for new crypto and blockchain related ideas.
Historically, that's been the case. ConsenSys has been this venture studio with about, I believe, 80 different companies that have gone through the accelerator and have received an investment. As you know, about a year ago, the crypto markets changed in a way that was productive for people who had a good business and unproductive for people who had a bad business. And so we've been going internally through a thinking process of standing up a strong business that is adding value in financial services. And so a large part of that is organizing the fintech offerings that ConsenSys has built internally, owns 100%, has learned from, I think, 50 different digital transformation projects that the company has consulted on, and trying to stand that up as its own offering, which is Codify.
Okay, so I think this is actually a great moment in time to kind of pick up this specific topic and kind of ask you to walk us through where we are, because basically, as you're saying, pre 1 year ago, there were hundreds and hundreds of interesting cutting edge projects, right? And who knew where any of this stuff was going to go. And there were some consortia who were looking to do stuff kind of at enterprise scale, and some things, Ethereum or Coinbase, had gotten some mass market traction. Implosion, at least in terms of token prices, as you're saying, made people reflect around where value was, where sustainable businesses were. Where would you say that we are today coming out of that? What sorts of conversations, what are the main focus areas of the people that you see as being serious, reputable, and at the leading edge in this space right now?
So it's like after a really strong rain, the grass smells really good. And that's the moment that we're in. Things are starting to grow again after this fairly destructive period. And I think when you look at the crypto economy as a whole, I split things out into two paths. The first is the asset class. So thinking about Bitcoin or other tokens as things you would invest in for capital gains. And that has seen both big businesses being built, like Coinbase and Binance, exchanges, brokers, as well as this massive value destruction as speculation became separated from fundamental value. The second arm of the sector, and the part that I find a lot more personally interesting and compelling, is the idea that you can build software into global distributed networks. So it used to be that you would run software on your desktop, right? You have Excel, you open up Excel on your computer, and that's where it runs. Then the next step is you want to put all of this stuff on servers. So servers are going to run our software, and eventually that's the cloud. So now you open up Google Sheets, and that's where you do your computing, is on somebody else's massive cloud. Step 3 is running software not on one machine in somebody's cloud, but instead running it on a global network across thousands, if not millions, of nodes that are simultaneously doing the computation and that are all agreeing on both the data and the workflow that they generate. And you can't have this without massively modern hardware and digitization and new types of habits. But that's the world we're about to go into, and that is a different operational view of how we access value. And the asset class almost doesn't matter at all in that context. What matters is, are there business problems that we can solve and attack in a different way using this infrastructure? And so, like you said, there's been a shift in the conversation. And I've been trying to find ways to connect how the different risk profiles connect, or how an enterprise blockchain project and a really innovative decentralized lending project, like what is in common? And so I think the answer is actually fairly straightforward, and it's just understanding what the evolution looks like. And so we start in 2015 with mutualizing the data and the data standards in different industries. So consortia will say, for an account to exist, these are the fields the account has to have. Why do we do this differently for every single broker-dealer, and then differently for each state, and then differently for each country? I mean, it's nonsense. And so having just the data standard that's shared across the industry is great. And then from the data, you go into workflows. So why does every broker open accounts in a slightly different way? Why are there thousands of account opening software companies? I mean, there's no value from recreating the wheel. And so these workflows are being built by consortia, by enterprise blockchain consortia, powered by Corda and Fabric, Enterprise Ethereum, into the software to open accounts and to do things with the data and the other workflows downstream, like financial planning or collateral management. All of that starts living in the network itself. And then once you have the workflows, you want to apply them to something. So you want some sort of token. You want some abstraction, like a hyperlink to the real world. And so that's digital assets today, right? So if you've heard about security token offerings or tokenizing real estate, or even digital assets like cryptocurrencies, I mean, all of these are tokens that contain real-world information. And so today, we have very little real-world information in the token. It could be just 1%, reference to some legal structure in Liechtenstein. Tomorrow, that token might also have software functions like distributing interest or doing share stock splits or some sort of governance. So it's 5% of the information. In a few years from then, you might have 20% of the information, like the ability to trade it or the ability to underwrite may live in the network itself rather than external software. Until you get to the world of decentralized finance, of which we see symptoms today, where all of the industry software, the entire value chain, is software that is written and exists on a blockchain-based network. And so it's really interesting for me to see these different symptoms happen at the same time. But I think it's really just a matter of risk tolerance and timing.
So it sounds like what you're describing is operational efficiency improvements, i.e., some of the clearing, settlement, processing, coordinating disparate members across the same network or the same group of institutions dealing in specific lines of business, rather than any sort of either financial or experience enhancement currently, and that potentially once the operational side is dealt with, there are opportunities for continued enhancement, which may end up reshaping financial products or customer experience.
I think the back office has gotten really boring because it's gotten staid and commoditized. But it's much bigger than that. So think about the shift from coal to electricity as a power source, right? Yeah, it just happens to be what you get power from, but it's massively different. Or think about when the compact discs became digitized and became MP3s, and all of a sudden it costs $0 to copy and paste, to manufacture the thing itself, the music, right? Forget the fixed cost. To make the incremental MP3 costs nothing. So when you get to a place where manufacturing the actual industry object has no cost attached to it, funny things tend to happen. With media, manufacturing of cost for content went to zero, and all of a sudden you had millions and billions of websites, and then you had Google appear. You can't have Google sit on top of books in the 1920s. Similarly, for music, you can't have a Spotify of CDs. It's nonsense. Netflix did a great job, but I would say the same thing. You can't have Netflix of videotapes. It's nonsense. You need the thing to be digital and free in the first place. And so what programmable, and I say programmable because I think it's really important to have this concept of being able to build software into the networks and have it run in the networks. If you have programmable blockchains and you manufacture the financial instruments there, then you start to open up the space for the Spotify type experience. And that looks really different from Revolut and Robinhood and all of these point solutions that are trying to push product at you.
So I think in the past maybe 2 weeks, you participated in a ConsenSys event, and you participated in Sibos here in London. What are your takeaways, general reflections as you think about those two events and as you compare them?
So I'm like a small town comedian doing all the clubs that I can get into. This past month in September, we just launched Codify on the 15th, and I did 10 different conferences. Sibos being one of them. I also did the Robo Investing Summit. I did Lendit, Ethereal in Tel Aviv, which is the ConsenSys conference, and a whole bunch of others that are a little bit more institutional, some of which were behind closed doors. And so one of the reasons I love this sector is being able to talk to folks who run multi-billion-dollar, gigantic, clearing and settlement organizations that underpin incumbent financial services that couldn't care less about what you do on your phone. And then talk to 21-year-olds who are blockchain native. When they learn programming, they don't learn how to build a website. They learn how to build a lending optimization algorithm that finds interest rates in the future by reverse calculating, what the lending protocols are going to project into the next block. Stuff I do not understand, but love hearing the energy behind that. So these are the bookends of the experience. And I do think there is glue between them. I don't think they're so far apart that you can't connect them. The sort of maturity curve I've walked through is one connection, but I would say the Sibos crowd is now out of the proof of concept mode. So they've spent 3 years working with IBM and R3 and similar companies. And now they're saying, what's the next step? So what? I think generally people think that equities capital markets are very efficient, and so there's not a ton to do there other than maybe the settlement custody part. But the asset classes that are chunkier and have less efficient markets, there is more opportunity. So that is real estate, that is structured product, derivatives, municipal bonds. People are excited to build markets for those and create transparency. And then on the other side, in the entrepreneurial world, people are just breaking down and recombining finance instruments in a way I've never seen before, because out of the box, you can get the equivalent of a bank account, the equivalent of a loan, the equivalent of what would be a venture capital issuance and what we saw as ICOs in 2017. All that stuff is programmable, and people are splicing bonds to separate the coupon from the notional. So it's just a ton of innovation, and I hope that we find a way to bring it back to the traditional industry and get people excited about it.
So it sounds like a ton of meaningful progress is being made. It sounds like people learned lessons from the crypto boom, if we can call it that, of 18 months ago. How do we avoid the same, this hype cycle? People are rushing in, bad code, bad concepts, bad sales practices. How do we avoid that and make sure that this time we're actually driving sustained progress?
I think that's an existential question for this industry, which really wants to be so liberated and independent and disruptive at its core, but it's finding that we're a bunch of human beings that live in societies, and we're tribal, and we've got countries, and we've got authorities and regulators, and that for mainstream adoption, you have to find a way to persuade people that what you're doing is kosher, what you're doing is good for them, and that it's not going to get shut down. And so if you think back to kind of the music or the Uber examples, yeah, Spotify makes it really easy for you to listen to music, even though the market price is kind of weird. $10 a month for all music ever recorded still seems to me a little bit like piracy. It's just easy now. The other thing that Spotify offers you is this feeling that it's legal. They do the hard work of the licensing and getting all this stuff together, and then they have a great user experience. And so you're really just paying for that impression that you're interacting in a legal way rather than having to steal the music for free. It's just more convenient. And it's the same thing for Uber, right? So Uber, what they've done is they drove the manufacturing cost of transportation from $1 million to zero. So it used to be if you want to run a taxi, you have to buy a taxi medallion. It costs $1 million. If you don't have $1 million, you go to the Taxi Medallion Corp and you take out a loan, and you're an indentured servant for the rest of your life paying off this loan. So Uber created a substitute equivalent to the Taxi Medallion. They did it by relying on a different licensing regime, breaking some rules, then using GPS and leveraging the mobile phone to create the sort of same asset as the Taxi Medallion would have been. So the whole taxi infrastructure, if you look at the price of a Taxi Medallion today, it's something like $150K. So 85% collapse in value, super similar to what's happened in finance otherwise. And so you get to use Uber and feel like what you're doing is legal and safe. They're the ones that are breaking the rules, but you get to feel safe, like it's okay. And I think that's what is sort of slowly happening in crypto, where it started off being on the edges and really flaunting its permissionless and trustless state. And I'd say today, after watching first the Mt. Gox hack for Bitcoin, destroying a ton of value. So then people got wise to maybe we should secure our payments. Number two is the DAO hack and the destruction of a $170 million venture fund. Well, maybe we should secure our code. Then the next one was the ICO bubble and people losing a ton of value there. But it wasn't that the whole thing, fell apart at its core. It's that you had sort of human behavioral failures at the edges and lots of gaming of people's investments and misrepresentations. So now we've got payments, we've got venture, and this was essentially like equities, equivalents, issuance, capital markets, everything that is going on with Binance and Coinbase. So now we've got through the equities market, and we know that all of these things have to be regulated. People have come around to that idea. And so in today's environment, it's security tokens, it's real estate, and those fall under severe regulation. The lending bits are the ones that are the most crypto anarchist. And so I think we are due to see the OCC and the banking regulators start looking at those players as performing banking or lending activity. The way that they were confused about digital lenders in 2007, I think they'll be confused about decentralized lenders in 2019. But I think with every crisis that the crypto ecosystem has faced, it's come closer and closer to being real. Like the shock is smaller and less existential. It's more educational, and it just adds rigor to the foundation. And I do think the other side of the story, which is the traditional incumbents becoming more blockchain savvy and understanding what's happening, is driving towards this convergence of the themes where the private and the public chains will be interoperable, and we're going to find ways to have assets travel between them. But it requires legwork. It requires human effort. It's not just going to happen on its own.
So I didn't hear a clear answer as to how we avoid this happening again. It did sound like some of it is just growing pains. Like as we explore new areas, some people are going to get there first. Maybe people won't always use best practice. I mean, it is human nature after all. So likely there's a bit more rockiness between here and kind of the ideal end state.
Yeah, I don't think we avoid crashes. There's nothing you can do. It all comes down to incentives and why people do things, right? So if you look even at traditional tech, stories like Uber and WeWork highlight some of the damage that you do when you say, in the most hyper-competitive capitalist environment in the world, you get to walk away with $1 billion if you're the meanest, the strongest, the fastest. And the systemic outcome you're going to get out of that is that you're going to have the strongest, the meanest, and the fastest compete to get that $1 billion. And you may not get the optimal results. At least in crypto, a lot of people are driven by the sort of communal concept where they're trying to build systems that help the many rather than trying to build systems where they aggregate an asset quickly. That's not always the case, but hopefully that'll be the heart of the matter.
Excellent. We will pick this conversation up again in the future, no doubt. Lex Sokolin, thank you very much for joining us today.
Anytime.
Thanks for tuning into Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.